All right, I think that's good enough. I think we can all get started. Well, thanks everyone. Welcome to LPC's second quarterly market update for 2023. For those of you that are new to our webinars, firstly, welcome. How we like to proceed is by the LPC team of experts providing a high-level overview of the Q1 status of the ANZ office, retail and industrial markets, and we'll be providing this commentary from a tenant's perspective. Today, the panelists include myself as moderator, Gillian, who will be providing statistical analysis on all the sectors, Ken, who will be touching on office, Adrian, retail, and Michael, industrial. Kicking off with the agenda, we'll go through the office market snapshot, then the retail, then the industrial, and at the end we'll have time for a Q&A, and if you have questions throughout the webinar, please don't hesitate to ask and we'll get to them at the end or answer them as we go. Just before we kick off with the office market snapshot, I just want to touch on a couple of recent articles from the AFR on the Australian office and retail and industrial sectors. So for office, top left, seen in both the recent sale of Dexus's premises in Sydney and Mirvac's in Melbourne, landlords are starting to feel the pinch on market conditions and as a result have provided discounts to their asset values. We at LPC believe this is the perfect time to push for more tenant-friendly terms and leverage the landlord's pain to improve lease terms. Ken will touch on this further in the office section. In retail, the bottom article, a breach notice has potentially been issued to David Jones from their landlord for not having the appropriate assignment provisions in their lease, which can have a significant impact on their sale of the business. Highlighting the importance of having tenant-friendly lease provisions, Adrian will speak more to how this example affects all tenants in the retail section. And finally, for industrial, the market continues to remain favourable to the landlord. However, is there an end on the horizon? Michael will confirm the challenge for industrial tenants in a very tight market. So kicking off with the office market snapshot from a tenant perspective, we'll have the summary of the vacancy data from Gillian, the Q1 status, market trends, and the tenant perspective.
Thanks, Ed. So according to the Property Council's office vacancy stats from Jan 23, our largest office markets are presenting a mixed picture. So Brisbane and Perth, along with their suburban markets, are experiencing positive net demand and declining vacancy rates. Meanwhile, our two biggest CBDs are Sydney and Melbourne, along with their suburban markets, Parramatta being the only exception, are seeing negative demand and increased vacancy. Brisbane and its fringe has recorded more than 150,000 square metres of positive net absorption in the past year. So despite these diverging trends, the flight to quality remains a prevailing theme, with most premium grade markets recording positive demand. As tenants seek to entice their workforce back to the office and companies evolve their ESG policies, the environmental and sustainability factors of a building are becoming increasingly important in premises decisions. Consequently, lower grade assets may struggle. I'll pass over to Ken now for his further insights on the office market.
Well, thanks, Gillian. So this slide illustrates the difference between lease norms and market conditions. So what we will do, this barometer will feature throughout the market update, and each presenter will discuss where each barometer sits within each sector. In relation to the office sector, look, I'll start off with the lease norm. So they are typically drafted in favour of the landlord due to the supply side and the landlord holding power. The ongoing challenge for tenants in this market is to push the boundaries and challenge the lease norms. This involves placing greater emphasis on clauses that are typically given less consideration by a tenant, which includes the transfer of risk, obligations, and guarantees back to the landlord. Market conditions. As reported by Gillian in the statistics, the market conditions are in favour of the tenants, which is largely driven by a slow return to work and tenants right-sizing their space requirements. With this in mind, it does present tenants with an opportunity to leverage the current market conditions and change the lease norms via restructure or other strategies that are implemented. Thanks, Ed. What is the status of Q1? Flight to quality. So this trend is still continuing as businesses are taking a step up to relocate to high quality office space, in order to get people back to the office and attract staff in this tight labour market. This trend is continuing across all capital cities. Speculative fit-outs. Historically, landlords have been providing speculative fit-outs for smaller tenants in the sub 500 square metre space. However, as a result of the rise in office vacancy and capital constraints for tenants, landlords are now building speculative fit-outs for larger users from 500 square metres up to 2,000 square metres. We see this trend to continue as landlords compete for a shallow pool of tenants. Leasing. In comparison to Q4, the level of leasing activity has decreased during this quarter, and as a result of the economic climate, tenants are putting their leasing decisions on hold. With this in mind, we are also seeing a rise in sublease space becoming available across the country because of the cost pressures and businesses struggling to get their staff back to the office. We expect sublease space to continue to rise throughout 2023. Occupancy. As reported by the Property Council of Australia in February, it showed an average occupancy of 77% across the country. However, we have good reason to believe these stats are based on Tuesday to Thursday, and it actually overstates reality as to what is happening. So what are the current market trends? Look, ESG, over the last 6 to 12 months, a lot of businesses actually have placed greater emphasis on ESG credentials and what landlords and buildings can offer. Some of the considerations that are currently being considered, or some of the questions that our tenants are actually asking landlords is where they source their power from and whether the building does actually offer a green power source. With this in mind, it does actually help our tenants reduce their carbon footprint, meet their ESG targets and their net zero targets. Workplace trend. Given the struggle to get people back to the office, a lot of our tenants and occupiers are still continuing to review their workplace due to the uncertainty around the supply side also. We expect this to evolve over the course of 2023 as businesses make the decision to go with a hybrid, hub and spoke, or to retain the traditional way of working. As I mentioned in the earlier slide, there is actually still a strong demand for premium or good quality assets, and we expect this the trend to continue as employees seek to provide better accommodation for their staff to attract and retain talent. Look, as part of our job, it is also to challenge the lease norms. And from our negotiations with the landlords, there is still a resistance from landlords to change the usual terms and conditions of a lease. Whilst there are incentives on offer, there is little focus given to provisions that relate to the risk, obligations, guarantees, and we are trying to place greater emphasis on these items throughout our negotiations. What does this mean for the tenant? So as shown in this table are the strategies that we implement for our clients along with the outcomes. So we will use this table throughout the presentation, which we will highlight the relevant strategies that apply to each sector having regard to the current market conditions. For the office sector, our recommendation to our clients is to focus on the highlighted ones, being lease restructure before expiry. So what this mean? Essentially, it means engaging early and reviewing your long-term accommodation strategy well ahead of the lease expiry. We often tell our clients time is leverage and actually costs nothing to go early. Look, in this current market, most landlords are under significant pressure, and it also helps to understand the landlord's position and their exposure in the marketplace. Speak to your advisor or someone from LPC who actually can help you gather intel on your landlord, so you're actually well equipped for your negotiations with the landlord. Workplace policy review and reset. As most businesses are still working from home and struggling to get staff back to the office, with the current market condition, it does actually present most businesses with an opportune time to review the way they work and understand what current trends are in the marketplace and what is best suited towards the business, whether it's the hybrid, hub and spoke, or utilising third spaces or co-working spaces within the building. But equal to that, it's also equally important to ensure that the lease contains appropriate provisions to support your workplace trends. For instance, flexibility clauses that provides you with the right to hand back or take up additional space throughout the term of the lease.
Thanks, Ken. Moving on now to the retail market snapshot from a tenant perspective. We'll again look at the leasing trends with Gillian. We'll then touch on the large format overview, shopping centre, CBD, and then we'll discuss it from the tenant's perspective.
Thanks, Ed. So despite the rising interest rates and cost of living pressures, face rents and annual rent increases are on the upswing across most retail sectors. So this trend persists despite households cutting down on non-essential spending. So retail rent reviews, they're typically based on CPI, commonly on a CPI plus, say, 2% basis. And according to the latest national CPI figure for March 2023, it now stands at 7%, up from 5.1% a year ago. So as a result, some of our retail tenants on CPI plus 2% review basis may now be facing their second consecutive year of rent increases of around 7 to 9%, even as the demand for non-essential goods cools. Given the current economic climate, it would suggest retail deals should be seeing tenants incentivised. However, the trends are suggesting otherwise. I'll now pass over to Adrian, who will provide his insights and advice to our retail tenants.
Thanks, Gillian. As Ken highlighted the barometers within the office market, the lease norms for retail remain unfriendly due to supply side power and market coverage that landlords hold as a collective over retail tenants, as well as restrictions within retail leasing acts. With the market conditions, they are quite varied over the different types of retail. In theory, they should favour the tenant. However, there is a difference between what is happening on the ground to what is being negotiated. As an example, with the retail market experiencing difficulty due to inflation and interest rates, landlords are responding by rapidly reducing the amount of incentives they are providing to tenants due to the increased cost of borrowing. If landlords are making changes due to inflation and interest rates, they should be acknowledging the difficulty also experienced by tenants and equally reducing rents or rent increases. Unfortunately, due to the fragmentation of retailers, the shopping centre landlords especially are unwilling to negotiate, and the tenants therefore placed in a difficult position to either accept their terms or potentially have to vacate and lose their business. Next slide. At the last market update, I commented that the leasing demand was strong. So whilst the leasing market is still buoyant, with landlords continuing to increase face rents, especially in stronger homemaker centres where there is no vacancy, we're starting to see signs that tenants are acting cautiously with their property decisions due to discretionary spending tailing off due to inflation and mortgage stress. We've even come across 2 large format retail centres in the past month where tenants have pulled out of new opportunities, hence a slight downgrade to good demand. Landlords are still resisting incentives on renewals, and these are now challenging to achieve and only really available for new sites. Currently, our large format clients are looking at current sites from a portfolio perspective with careful consideration and decision making based on informed data to either remain in situ or relocate to a superior location. With their new stores, there has to be an extremely favourable deal to even be entertained, especially given fit out costs and the cost of capital. Both of these strategies always have an end in mind to provide the greatest return for both the individual stores and the portfolio in general. Onto shopping centres. So most regional and sub-regional centres have now had turnover returning to pre-pandemic levels. However, foot traffic is still down due to the change of shopping habits. Shoppers now tend to visit shopping centres less frequently, but when they do go, their basket size increases to make up for the less frequent visits. Shopping centre landlords are pushing for longer term renewals with lessee works and rent increases on renewal by 10 to 30%. This is an effect from the COVID period where many short-term leases were agreed with no refurbishment works. Many tenants are also affected by relocations on renewals, as the landlords are looking to revisit tenancy mixes and tenants to maximise turnover and rental growth. As we discussed with large format retail, it is challenging to receive incentives from landlords. We are aware that Scentre Group has put a stop to offering incentives due to the cost of borrowing, and other landlords will only offer an incentive if it is reflected within the rental. The rate of inflation is influencing how customers shop, with a reduction of spend of non-essential products, researching product pricing, and an increased awareness of sales, cheaper products, brands, and stores. More tenants are experiencing a reversion of turnover from the past year due to the high level activity coming out of COVID, from people exiting lockdowns and being keen to spend money. Occupancy cost ratios increasing with the cost of goods, labour prices, and larger in-term rent increases, all having a negative effect on bricks and mortar retailing. Shopping centre landlords must take this into account when setting rental levels, otherwise this will lead to increased closures and vacancies. So with the CBD, the retail market is still affected due to the reduced number of office workers, as discussed earlier by Ken. And the major landlords believe that the CBD is predicted to remain in distress until late this year, early 2024. Many small to medium food tenants within a foyer or a precinct of an office building where there's been low visitation or high vacancy have not been able to survive. CBD landlords are still needing to provide more flexibility to attract tenants, for example, short-term leases, turnover-based rents, or partnership models to support retailers whilst transitioning through this period of low office utilisation. In the suburban market, again, food tenants are suffering, this time relating to the cost of living pressures. Staffing is probably the biggest headache, as due to people cooking and eating more at home, there is no consistency with customer habits, and turnover fluctuates greatly from week to week, making it difficult to know when to roster staff. There are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. In orange, we have highlighted 2 strategies that tenants can focus on. Firstly, portfolio optimization. For those retailers with a portfolio of 1 or more stores, look at your market coverage, review non-performing stores to ascertain why they aren't performing, carefully target new stores, and use data to inform these decisions. Secondly, lease restructure before expiry. As Ken mentioned earlier, time is your leverage, go early. Speak with other tenants in your shopping strip or centre to find out how their business is doing and what they are paying or incentives received. Look at alternatives and do it early if you have an option. Use it as your backup plan. Negotiating early or before your option is due to be exercised allows you to renegotiate your lease and look for opportunities to transfer risk, such as removing personal guarantees or additional option terms. Thank you.
Thanks, Adrian. Moving on to the industrial market snapshot from a tenant perspective. Again, we'll look at the overview of the stats, the current status, the outlook, and the tenant's perspective.
So the industrial real estate market is continuing to witness a steady decline in vacancy rates. In a previous update, we highlighted that Sydney had the lowest industrial vacancy rate of any city worldwide at 0.3%. However, we can see here that rate has now further decreased to 0.2. As a result of the low vacancy rates, net face rents have been on a continuous upward trend across all markets. Nevertheless, it remains to be seen whether the current economic conditions will have any impact. Moreover, our industrial users will face significant challenges in navigating this tough market. I'll pass over to Michael, who will now share his insights for our industrial tenants.
Thank you, Gillian. Look, despite not having any new data for this update, excuse me, it's fair to say that the industrial market remains, across all markets and across either side of the ditch, a very challenging market for the tenant. The market continues to be led by sustained demand for e-commerce, logistics, and food and beverage, and to a lesser extent, even manufacturers onshoring. While the supply side is not responding with any urgency whatsoever to address that uptick in demand, leading to an imbalance in the market, which in turn continues to place upward pressure on rentals. As Julian mentioned just a minute ago, the Australian market vacancy rate, excuse me, remains the lowest in the world, and I'll anticipate that once new data is released around mid-year, there will be little relief for the tenant. And as I reported in the last update, that we were going to watch Melbourne quite carefully because it seemed to have plateaued, that apparent stall in December is somewhat of an apparition, as recent reports are suggesting that the vacancy will further tighten once new data is released. Next slide, please, Ed. So just from an outlook perspective, the industrial market remains resistant to the economic tailwinds and the global uncertainty. Indeed, the Australian economy has rebounded after COVID, with GDP growth being around 3.5% to 4%. This is in spite of the fact that inflation remains at an undesirably high level. Again, as Gillian suggested earlier, the CPI figure did drop from 7.8 in December to around 7 in March, but remains well above the RBA's target range of about 3 to 3.5%. And as demonstrated earlier this week, after a short reprieve last month, the RBA will continue to use interest rates as their key monetary policy measure to curb inflationary pressures and the ongoing high levels of consumer spending. But regardless of the economic factors, the level of industrial demand remains at unprecedented levels. For me, the big question is whether the demand side will remain at those levels. There is some market evidence to support that demand is at least flattening off, and surely with further interest rate hikes and consumer discretionary spend to drop, that will have some impact. Keeping in mind the main driver for industrial demand has been on the back of e-commerce. So if the market behaves rationally and consumer spending decreases, surely demand for industrial space will also ease off too. Another factor that's more recently come into the play is the role of supply chains. During the pandemic, supply chains were severely disrupted and suppliers were stockpiling goods in order to be able to meet demand. However, supply chains have started to normalise, providing greater certainty around shipping. This could potentially lead to the rationalisation of inventory levels, and therefore it follows that there will be a freeing up of space. And perhaps there is some evidence of this as we're starting to see some early stages of the market responding, as there are a number of major occupiers attempting to sublease space. Another key factor is the supply side is just simply not responding to demand. This is probably largely due to the increased cost of capital, coupled with inflationary pressures on construction and building materials, which is stalling industrial development. There is virtually no speculative development whatsoever. Rather, industrial developers are committing only to construction once a tenant is secured and the rental rate supports their internal return requirements. Hang on, Ed. But perhaps there is some light at the end of the tunnel, with analysts at Barrenjoey suggesting that demand will waver and new supply will catch up and eventually to meet demand. They go on to suggest that as a result of equilibrium being reached, prices or rents will stabilise and potentially even in some areas, negative growth by 2026. We can but live in hope. Next slide, please. But so where do the opportunities lie? The industrial market has been in an upward trend for the past decade, experiencing year-on-year growth, decreasing vacancies and diminishment of incentives. Accordingly, there's been very little leverage for the tenant, both in terms of market conditions and lease conditions. And the sustained growth of the market has skewed the norm towards the landlord. In order to shift the needle on the barometer back in favour of the tenant, careful consideration of business needs, expert knowledge of the market, experience, and a fair bit of patience is essential. On the next slide, we'll look at some potential strategies that can assist in moving the needle on the barometer to a more balanced, tenant-friendlier situation. So it is clear that the industrial market is very tough for the tenant, which certainly limits the leverage available. Nevertheless, there are a number of strategies that we have used to better an industrial tenant's position. Our negotiation strategies turn on 5 key categories of cost, risk, flexibility, obligations, and guarantees. And whilst there's always attention given to the cost, in a market such as the current industrial market, driving down cost is not impossible, but a very difficult proposition. And it's arguable that better outcomes can be achieved by focusing on risk and obligations. As Adrian recommended earlier, the strategy we often apply, particularly for multi-site users, is a portfolio review in which we take a strategic view to identify opportunities to better align the client's property portfolio with its business needs in order to optimize its property's performance. Another strategy available is to look at mitigating risk and transferring obligations to the landlord, typically via a side deed or through a variation to an existing lease. Everything is negotiable, but make no mistake, it is hard yards and it takes skill, and as I suggested earlier, a fair bit of patience. But a good example of this in the industrial sector is a commitment or obligation on the landlord to meet or maintain certain energy targets through incentives such as solar power, harvesting and recycling of water. Increasingly, we are negotiating provisions in leases of this nature. So that's about it for me. I think I hand back to Ed now. Thank you.
Thanks, Michael. Now on to the Q&A section, and we had a couple go through as we went along. We have a participant who currently is in co-working service office, and they have a high turnover of space throughout the facilities and lots of empty desks. I guess this is a question for the office sector. How do they go about challenging the standard agreement and pricing of that the landlord is trying to get, and how they can get a better deal when the landlord seems comfortable letting tenants go before they drop their prices?
Yeah, thanks, Ed. I'll answer this. I think, as I mentioned at the start of the slide, leverage. So it's probably good to understand what vacancies are currently available within with your current provider and what rates they are asking, along with other competitors. Arming yourself with all the information and facts, and then having a discussion with your provider. I think that will definitely help the business negotiate favourable rates within the centre.
Thanks, Ken. With another one, with regards to the retail article at the start of the webinar, what are the implications of a potential lockout of David Jones on other retailers?
Okay, yeah, so I'll answer that one. So the background to this was that David Jones sold their business, I think early this year, and they didn't get approval from Centre Group, which is one of their larger landlords, for that sale to basically go ahead. So I believe in the lease there was a change in control provision that forced David Jones to seek the landlord's consent to the purchase of the business. Landlords often put this type of clause in to protect themselves that a business like David Jones is not sold to a new owner who doesn't have a similar track record or financial capability that David Jones might have. So for tenants looking at going into new leases, this change in control is something that's quite often overlooked. Some strategies to, I guess, overcome this is that that the landlord's consent is not required, potentially when a sale goes through, or potentially limiting it to the landlord's consent only being required when there's a change of ownership over 50%. So it really goes back to making sure that you focus on these little things within leases. There was also another recent article or situation in Melbourne where there was I believe it was a Kentucky Fried Chicken restaurant that took out a lease within a service station site and then tried to assign the lease to a Portos. And in the use provision, it actually said something along the lines of that the use provision was linked to a KFC menu. And the decision went all the way to VCAT, and basically the landlord was seen to be correct in not giving approval for the assignment to go ahead. So it's really important that things like use, things like changing controls, provisions are looked at when entering into a new lease, no matter if you're a large tenant or a smaller tenant.
Adrian, sorry, one question. When would you recommend that they document it in the heads of agreement or on the lease?
Yeah, absolutely, in the heads of agreement. Often it can be something that takes up a lot of time and money if it's not documented properly in the heads of agreement, and then you're fighting it out with the landlord solicitor, and often that you don't have the leverage to then be able to get the clause that you require.
it's all about keeping the end in mind, isn't it? It's you know, if there's any indication of sometime in the future that there may be an acquisition or disposition of the business, then it's absolutely essential to keep that end in mind and negotiate the provisions accordingly.
Yeah.
And as you say, that change in control is an often overlooked clause, glossed over.
You're absolutely right, Michael, because you know, David Jones, when they entered in some of these long-term leases, they might have been 10, 15-year leases. They wouldn't even thought about selling the business at that point in time. But it's now come about, and they're effectively in breach of a number of their lease agreements with Scentre Group.
Hmm.
And Adrian, just another one with retail that's just come in. Is there any trend data available on option renewals, especially in the retail sector? Effectively, are options being taken up or passed in, and has this changed over time?
So, look, in retail, it's difficult across the different sectors. I would say that in shopping centres, especially, the shopping centre landlords will not offer options. So there's not, you don't really find too many options within the larger shopping centres, and it's becoming less frequent in the large format retail sector as well. With strip retail, there's obviously still a lot of options. I don't have any data on whether they're being exercised or not, but as I mentioned earlier, options really should be seen as a backup plan. You should be starting to discuss and negotiate with your landlord 12 to 18 months out at least, to try and get a better negotiation. And then if you can't get that negotiation, you've got that option there as a backup to protect your business.
Thanks, Adrian. One last one. I guess this is for everyone. Are we seeing much accommodation from landlords where tenants need to leave early due to business sustainability, and how is this being negotiated?
I think go back to my earlier point, it's probably look, most landlords are receptive to tenants, but it really depends on what the landlord situation is also, and understanding the position. For instance, for a couple of our call it retail clients, there have been cases where the landlord has had another tenant that was looking to backfill the space. So the landlord was more receptive for the tenant to vacate, whereas for instance, in the office space, we've had a number of cases where the landlord has actually had significant vacancy within the building, but the size of the office was too large, and in return for us, in reducing our office space, our client did provide them with a longer term lease in exchange for a reduction in occupancy costs. So it is a bit of a trade-off, but it's probably good just to understand what you can and can't leverage with the landlord.
Perfect. Thanks, Ken. Thanks all. Run a bit over time, so we'll just wrap it up there. So thank you everyone who joined us, and thanks to our panelists. And remember, our next update will be in August, same time, and hope to see you then. Thanks everyone.
Thank you.
Yep, thanks guys, thanks.